Welcome to this video from Kepsfield Academy. In this video, we will explore various types of stock, the value of equity, and the Gordon's growth model. Stocks, or shares, represent partial ownership in a company's equity. Companies issue stocks to raise funds for business operations, investments, and growth. Shareholders are entitled to a portion of a company's assets and earnings, making stockholding an attractive investment option due to dividend payments and capital gains. Companies can choose to distribute earnings through dividends or retain them for reinvestment. Shareholders can be compensated with a cash or stock dividend. On the other hand, retained earnings which are reinvested can increase a company's value, leading to capital gains for shareholders. There are two widely used types of shares: common shares and preferred shares. Common shares come with voting rights, while preferred shares have priority for dividends but no voting rights. Let's explore various methods for valuing equity. We can make a distinction between the book value of equity, the market value of equity, and the intrinsic value of a company. The book value of equity is the amount reported in a firm's financial statements. Think of it as what's left after paying off liabilities and selling assets. However, keep in mind that it may not accurately reflect a company's future profitability and is subject to accounting standards. It's a good starting point, but not the whole picture. Fair value, also known as market value, refers to the market capitalization of a firm's equity. Simply put, it's calculated by multiplying the total number of shares outstanding by the share price. Fair value fluctuates with changes in share prices and assumes that markets are efficient in determining the value based on available information. It's a snapshot of what the market thinks the company is worth right now. Intrinsic value is like the true value of a stock, taking into account its future potential. Financial analysts use various methods to estimate intrinsic value, which reflects the actual worth and future potential of a stock. One such model is the Gordon's growth model, which considers future dividends at a constant growing rate. If the intrinsic value is higher than the market value, it might be a good opportunity to invest. As mentioned, a useful method in determining a stock's intrinsic value is the Gordon's growth model. We'll explore the model's three main inputs: dividends per share, growth rate, and discount rate. We'll also discuss the no-growth model, constant growth model, and the multi-stage model. Dividend per share measures a shareholder's income over a period. This metric plays a crucial role in valuing equity with Gordon's growth model. It's calculated by dividing the total dividends by the number of outstanding shares. The dividend growth rate is the annualized percentage rate at which a firm's dividends are expected to grow. The sustainable growth rate is particularly useful as it reflects the maximum rate of growth a firm can sustain without relying on additional equity or debt. It's calculated by multiplying the retention ratio with return on equity. The discount rate, or cost of equity, represents the interest rate demanded by stockholders for bearing the risk related to owning a specific company. It varies from company to company and is essential for calculating the intrinsic value of a stock. Now that we've covered the main inputs of Gordon's growth model, let's explore the three commonly used variations: the no-growth model, the constant growth model, and the multi-stage model. Each model has different assumptions and methods for calculating the intrinsic value of a stock. The no-growth model assumes constant dividends in perpetuity and firm immortality. The intrinsic value of a stock is calculated by dividing the expected dividend by the company's discount rate. Also known as Gordon's growth model, the constant growth model assumes firm immortality and internal growth. It predicts growing dividends in perpetuity. The intrinsic value of a stock is calculated by dividing the expected dividend by the difference between the discount rate and the dividend growth rate. The multi-stage model accounts for varying dividend growth over different stages. It abandons the constant dividend assumption and treats each stage with non-constant dividend changes separately. There's no universal formula for this model, but understanding the calculations can be achieved through case examples. While the Gordon's growth model is popular and easy to understand, it's essential to be aware of its limitations. One issue with the model is the assumption of perpetual growth. It assumes that firms exist indefinitely, and their dividends grow constantly. However, companies can terminate due to financial distress or a lack of successors in family businesses. It's also difficult to achieve constant income growth as market conditions are unpredictable. Additionally, the model breaks down mathematically if the growth rate is equal to or greater than the discount rate, leading to unreliable results. Another aspect to consider is the model's reliance on payout ratios. The Gordon's growth model is designed for firms that pay out dividends, but many companies don't. While the model does account for growth based on the retention ratio, it may not accurately capture the full value of firms that choose not to pay dividends or have irregular dividend payments. As a finance professional, it's crucial to consider the implications of different payout ratios when assessing a company's performance. Finally, stock buybacks can significantly impact equity valuation. In a share buyback, a company repurchases some of its shares, often at a price above the market rate. This reduces the number of outstanding shares and increases the share price, resulting in capital gains for shareholders. The Gordon's growth model might not fully account for the impact of buybacks on equity valuation, as it focuses on dividends. It's essential to keep this in mind when using the model for valuation purposes. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.